Hey, what's up, everybody? It's Friday, July 22nd. Yeah, Friday. All right, we had a little bit of a pullback, a little profit taken in the market today. Not a big surprise. Yesterday was another positive flow day of about 10 billion, so that's good. It brings the deficit for the month of July up to 150 billion. That is like the biggest deficit, monthly deficit we've seen in a while. I got to go back and check, but we are now about 33 billion from completely recovering the April tax drain. So, it's been a slow process. We're 3 months on from that tax filing date. 325 billion was drained out, and it's just been a slow process of recovery of that money. It's happening, it's just happening slowly. The good news is the deficit for the fiscal year so far, that's at 865 billion. That is the highest level since the week ending April 14th. So the deficit is back to where it was pre-tax drain. And if you're wondering, that deficit is about 3.54% of GDP, but it is down like 1.54 trillion year over year. Just goes to show you how much less, fiscal has been pumped in this year compared to last year. And that's really what we're going through right now. It's not an inflation situation. I'm not saying that there's no inflation. Don't attack me. I understand, yes. But the real reason why the economy is slowing down and why, the stock market has been struggling is that fiscal pump has been greatly reduced. The flow out of that fiscal pump has been dramatically reduced. Okay, and we need to, what's happening is that the economy is just trying to find a new equilibrium level, some stability, and then, growth will resume, but at a slower pace. So that's what we're going through. But you know this because I tell you this stuff every single day. The pullback today, look, we had some bad earnings on Snapchat. I think Snap was down like 40%. Some people are saying it's like in its death throes right now. I don't use Snapchat. My daughter does. I think that's mostly a young people's thing. But whatever. Next week we're going to have tech earnings. There might be some worries or angst leading up to that. Let me say that I spoke about the earnings situation with respect to what we've seen leading up to it with the stock market. I said that the stock market has already discounted second quarter negative GDP growth, and along with that, the slowdown, if any, in corporate profits. So I also said that the market's going to absorb these bad earnings reports when they come along, and so far that has been correct. So I don't see a big issue next week with the tech earnings, even if they come in as a disappointment. Yes, you're going to get the reflex reaction, you're going to get the knee-jerk selling, but it's like what we saw with the bank stocks, with JP Morgan, with some of these financials, and then they bounce back. I mean, this is the typical. I mean, if you've been in the business as long as I have, there's a trading reaction, and it's mostly based on emotion. What I like to call headline trading, and then there's the underlying true fundamentals, and that ultimately is going to decide what will happen over a period of time. So yeah, we may get some headline trading next week. It may be a little volatile, but as far as earnings are concerned, they are already baked in, I believe, to the market averages and stock prices, which have, basically, look at stocks that have declined or were in a decline for 5 months, a pretty significant decline. So a lot of the negative news has been discounted. Next week, of course, we get the Fed meeting on Wednesday. Now, right now, Fed fund futures are pricing in the probability of a 75 basis point rate hike. I've been talking about this, I think it was last week. We saw that probability jump up sharply to a full percent and 100 basis points, but that didn't last very long. 10-year bond yields have fallen down below 2.8%. I made a video a couple of weeks ago. I don't know, maybe it was last week. I forget. You can go back and check it out. I said that treasuries are a good place to be right now. You're going to get a rally in treasuries, and that is what is happening. We also saw today that there was an agreement between Russia and Ukraine as far as resuming Ukrainian wheat exports through the Black Sea. And this resulted in a sharp decline in wheat prices. By the way, if you also look at lumber prices, some of these commodities now are back to, pre-war and even lower levels. So there's, that's also an element in this bond market rally. I guess the element is that we're going to see some dissipation, some calming down in the inflation impulse. Ironically, though, it's again something I've been telling you guys that the central banks don't seem to understand this, is that their rate increases will keep the general price level higher than what otherwise would have been the case if they weren't raising interest rates. I mean, that's just a fact. That's just reality. And again, the cost of credit is reflected in the cost of all goods and services. It's the price of that credit that flows into the cost of manufacturing something or producing something or transporting something or selling something. And, that's just reflected in a higher price. Producers lift the price in order to cover some of that interest expense. This is a reality, but it's completely antithetical or opposite how central bankers think. I mean, their orthodoxy, the way they see things is that higher interest rates squash inflation, but that's just patently not true. I mean, if that were true, we'd see places like Venezuela and Argentina and, Turkey and other places like that where they've just been on a nonstop war of raising interest rates, and it just accelerates the rate of inflation. So the Fed's going to do the same thing. Of course, we're not talking about the same kind of interest rates as what you see in Turkey or the aforementioned countries, but still, it's not something that is, look at Japan, where they're still, they still have a zero rate basically, and inflation is like basically non-existent in Japan. And that's even with Japan being a major net importer of petroleum. So there you have a good example. And we saw this week the ECB raise rates by 50 basis points. That's going to feed through into higher inflation levels too. But that's the 50 basis points is not like an exorbitant rate of interest, but it is an increase. And so, like I said, as long as these central banks keep increasing interest rates, two things here, and I've mentioned these things numerous times. Number one is you're just going to keep the price level that much higher. And number two, it's a fiscal operation. So you raise the interest rate, and governments and the central banks themselves have to pay higher interest, either higher interest on reserves or, in the case of governments, higher interest on their securities. So that flows That's a fiscal injection that through the interest channel into the economy. Unfortunately, it's mostly wealthy people and financial institutions that get that money. It's not the broader population who is probably in greater need of those flows. So, I mean, it's kind of like universal basic income for rich people and banks. That's the system. Don't get mad at me. That's the system. That's what they're doing. Now they're cutting flows to regular people. They're cutting financial help and fiscal support to just regular working people. But I mean, this is what's going to happen with these rate hikes. So you got two things. You got just a higher general price level, and it's a fiscal expansion. Now, some of that does trickle down. It does flow through the economy. So it's not a bad thing. I don't see that as a bad thing. I mean, the price increases that come from higher rates, yeah, you could say that's a bad thing. But the fiscal, I mean, that's okay. QT, folks, QT is not really happening. I just looked again at the Fed's balance sheet. It was up for the second week in a row. I think it's at the highest level now in 4 weeks. So I don't know what's going on there. I don't know if somebody messed up at the New York Fed and did something backwards from what they were supposed to do, but very, very small decline in the Fed's balance sheet. They started in June. We're almost in August now. August, I think, June, July, August. I think by the end of August, they're supposed to go up to $95 billion a month. I mean, they're nowhere. They're not even near. I don't even think they're near what they got to be doing now, like 47 billion or 45 something billion a month. They're nowhere near that. So everyone who's freaked out about QT, and interestingly enough, I started to see some stuff online about people now questioning, whether the Fed is actually going to go ahead and do QT because they don't see it, like myself. You just don't see that manifesting in the data. It's just not really happening. And it needs to happen, by the way, because of what I talked about yesterday. As the fiscal contracts, as that government spending slows down, the non-government, the economy, necessarily taps into more credit. I talked about this yesterday. It's the desire, it's the need to maintain a level of output and business activity. They strive to do that. It's like a kind of a, it's just like they try to maintain the same level of sales and production, and so they tap into credit. It's kind of like a survival mechanism. And so haven't really seen much of a decline in reserve balances, so the Fed really needs to get going on QT. If they did that, and again, I mean, this is something I spoke about so many times, I'm looking forward to it because it would result in a much faster pace of credit creation. Not that it's going slow now. Actually, in some, in some of these bank metrics and some of these loan metrics, we're seeing credit growth and loan growth at the highest rate in like 14, 15, 16 years. But again, as the fiscal shrinks, there's just more demand for credit. So really, if the Fed were to get going on this to the degree that they've been promising, I think that would just create an even more bullish outlook. So anyway, folks, that's it. It's Friday. Enjoy. Go have a beer, a glass of wine, whatever your thing is, and maybe I'll try to do a video over the weekend. But if not, have a good weekend. Take care. Bye.